Good morning. Welcome to this webinar on the fundamentals of VAT. I'm very happy to be here. My name is Samir Ansari. I'm a tax agent and also a consultant at Alif Accounting and Tax Consultants. Our company, Alif Accounting and Tax Consultants, offers a complete range of accounting and taxation services. We can also help you with ERP implementation and many other services like opening a bank account or your VAT returns, filing payment, corporate tax returns, filing payment, and many other services we can help you with. So with that said, let's start. Let's jump right in. Okay, so let's begin right at the start. What is value-added tax? Value-added tax is a 5% or 0% tax levied on the sale of certain goods um, at the point of sale. And this is an indirect tax in that the middleman or the seller charges VAT to the buyer, and then the seller collects this VAT and remits it to the FTA. So because of the middleman, because of the intermediary, it's called an indirect tax. The government agency which is responsible for the management of all federal taxes, which include which include corporate tax, value-added tax, and excise tax, is the FTA, the Federal Tax Authority. I'm sure you heard their name before. I encourage you to visit the website tax.gov.ae. If you have any questions or doubts, I often visit this website. There are many legislations, guides, forms, public clarifications, and other documents available online. It is a wealth of resources, and if you have any questions or you are in doubt, you can always access this. Okay, so how does the VAT rate in UAE compare to the rest of the world? Right now, I'll compare to the GCC. UAE's VAT rate is 5%, along with Oman, which is also 5%. Bahrain has a VAT rate of 10%, and Saudi Arabia has the highest VAT rate of 15%. Kuwait and Qatar have not yet adopted VAT. UAE's has a low VAT rate. If you look at it globally, even the UK and Europe, they have a VAT rate of 20% plus, more than 20%. So overall, UAE has a very low VAT rate, and this is in line with the UAE policy to encourage business and commerce within the UAE. Okay, so the basics of VAT. There are two very important definitions. That is of input tax and output tax. Input tax is the VAT that is part of the expenses suffered by an entity on your purchases and your expenses, and input tax is recoverable to the FTA. Output VAT is the VAT charged on the sale of goods, 5% or 0%, and this has to be remitted to the FTA. At the end of each quarter, when you file your tax return, you have to compare your output tax with your input tax. Output tax, if the output tax exceeds the input tax, then the difference is remitted to the FTA. If input tax exceeds output tax, then the difference is recoverable from the FTA. So this is in this slide, you can see how a supply chain looked before VAT implementation. You have here the producer, the manufacturer, and the retailer. In this slide, you can see that there is no VAT. The producer charges the manufacturer 100 dirham, and then the manufacturer, he adds his profit margin and makes it 180, and he sells to the retailer, and the retailer then sells to the end consumer after charging their markup of 20 dirhams. The scenario completely changed on 1st January 2018 when VAT was implemented. Here you can see that the producer is charging the manufacturer 100 dirhams, and 5% of that is the VAT rate. So 5 dirhams is the output tax. This output tax of the producer has to be remitted to the FTA, which is what's being done here. It's being remitted to the FTA, and that output tax of 5 dirhams is also input tax for the manufacturer. So then the manufacturer charges 180 dirhams to the retailer, and the 5% of that is 9 dirhams. So the output tax for the manufacturer was 9, the input tax for the manufacturer was 5, and 9 minus 5 is 4. So this net amount of 4 is remitted to the FTA. Similarly, the retailer then buys from the manufacturer, and the input tax is 9 dirhams. So here you can see the 9 dirhams input tax, and the retailer charges 200 to the end consumer, and that is 5% is 10. So 10 minus 9, 1 dirham is to be paid to the FTA. The last step in the supply chain is the consumer. The consumer is an individual like you and I. He is not registered for tax, so he cannot claim input tax, and the whole VAT amount of 10 dirhams will be borne by the consumer. To further illustrate this very important point, please look at this slide where the manufacturer is selling cars to a car dealer. The manufacturer sells the cars for 100,000 dirhams, on which he applies 5% VAT. 5% of 100,000 is 5,000, which is the output tax for the manufacturer. For the car dealer, this is a purchase. So this 5,000 dirhams is his input tax. The car dealer then sells to the end consumer. He charges 120,000 dirhams after a markup of 20,000 dirhams, and 5% of that is 6,000 output tax for the car dealer. So how would the tax return look for the car dealer? Output tax, as we discussed, is 6,000. Here's 6,000. Input tax is 5,000. The net amount is 1,000, and this is payable to the FTA. Now I will show you another situation where money is recoverable from the FTA. The manufacturer, he sells 5 cars, each costing 100,000 dirhams. That's 500,000 dirhams plus 5% VAT, which is 25,000. This is output tax for the manufacturer and input tax for the car dealer. Then the car dealer bought 5 cars, but he's only selling 2 cars at 120,000 dirhams each. So the total is 240,000 dirhams, and 5% of that is 12,000. Here you can see how the return of the car dealer would look. Output tax is 12,000, this that he suffered here. Input tax is 25,000 on his purchase from the manufacturer. The difference is 13,000, which is recoverable from the FTA. It can be claimed from the FTA. So I've shown you 2 situations, one in which tax was payable to the FTA and one in which tax was recoverable from the FTA. Okay, so the scope of UAE VAT, categories of VAT. There are 3 basic categories of value-added tax. These are taxable supplies, exempt supplies, and out-of-scope supplies. Taxable supplies are either 0 rated or standard rated. For zero-rated supplies, it is a very favorable position because you do not need to charge output tax, and at the same time, you can recover input tax. For standard rated sales, you must charge output tax, and you can also claim input tax. For exempt supplies, there is no input or output tax. And finally, for out of scope supplies, these supplies are outside the purview of VAT, and there is no input or output VAT. Now, for the input tax outline. For expenses related to taxable supplies, they can be fully recovered. For expenses related to exempt supplies, input tax cannot be recovered, and for expenses related to both taxable and exempt supplies, input tax can be partially recovered. I'll give you an example. You have a building that has residential units and commercial units. Commercial units are charged at a 5% tax rate and are taxable supplies. Residential units are exempt from tax. So if you have the electricity bill of the entire building, you can claim that amount of VAT, which is on the taxable supplies or the commercial units. However, the residential units being exempt, you cannot recover input tax on that. There are certain blocked input VATs. You cannot recover input tax on entertainment, and similarly, you cannot recover input tax on expenses related to motor vehicles, which is used privately by the employees. So I will give you a few examples of each type of category that I mentioned before, and we start with zero-rated supplies. As you know, this is a very favorable position because you do not need to charge output tax and you can recover input tax. Generally, the FTA, the UAE has made zero-rated supplies on goods and services which they wish to promote and encourage in the market. First of all, we have export of goods and services outside the implementing states to the rest of the world. For example, you are in the UAE and you're exporting goods to the United Kingdom. This will be a zero-rated taxable supply. International transport of goods or people. Either for example, you have a plane ticket, you're going from the UAE to the United Kingdom, this will be zero-rated. Similarly, transport of cargo will also be zero-rated. Supply of investment precious metals. This includes platinum, silver, and gold. Supply of a residential building within 3 years of completion. Residential buildings and apartments and these will, if they are supplied within 3 years of completion, then they will be zero-rated. After the time limit of 3 years or on subsequent supply, these residential buildings and apartments will be exempt. Healthcare services and educational services, as long as they are approved by the government entity and by the government entity responsible, and they meet certain other criteria, these will be zero-rated. Finally, supply of crude oil and natural gas. These are unprocessed hydrocarbons, and the supply of crude oil and natural gas is zero-rated. Exempt supplies. On this, you can neither charge input tax nor you cannot claim input tax, nor can you charge output tax. This includes certain financial services, local transport of passengers, not goods. For example, you are taking a taxi, an RTA taxi, or a bus, or you're going on the metro. These are all exempt, and there will be no output tax or input tax on these. Life insurance. Supply of residential properties which are not zero-rated, and supply of bare land, which means empty plots of land. Supply of residential properties. I told you earlier that the first supply within 3 years of completion is zero-rated. However, subsequent supplies and those supplies which are done after 3 years are exempt. And finally, the last category of VAT is outside the scope of VAT. These are not within the purview of VAT. Salaries and wages to directors and employees, these are outside the scope of VAT and there is no VAT applicable. Intra-group supplies. You have a VAT group with a parent and several subsidiaries. The transactions between the members of the VAT group are not taxable and they are outside the scope of UAE VAT. Sale of vouchers at face value. Here, if you have a voucher that has a face value of 200 dirhams and the face value and the amount you pay are 200 dirhams, they're the same, then this is out of scope for VAT purposes. However, when you redeem the voucher, at that point, it will be taxable. Sale or purchase of a business as a going concern. This means that you are selling your business from one taxable person to another. This is also outside the scope of VAT. Finally, interest income or dividend income. For example, you have interest in your bank account or you have dividend income. You bought stocks of a company and they're giving you dividends. This is also outside the scope of VAT and there will be no VAT charge on such supplies. Finally, standard rated supplies. For those goods and services which are not exempt, out of scope, or zero rated, all of these supplies must be standard rated. This is the default category, and most transactions are standard rated. Examples of standard rated supplies and goods are supply of food and beverages, local transportation of goods, and rent and sale of commercial buildings. Place of supply. This is a very important concept because if the place of supply or the location of the supply is the UAE, that means that UAE VAT will be applicable. If the place of supply is outside of the UAE, then there is no UAE VAT implication and the supply is considered out of scope. So for goods, the default rule is that if the goods touch UAE soil, then the place of supply is the UAE and the place of supply and the UAE VAT will be applicable. For example, if you're exporting goods out of the UAE or you're importing goods into the UAE or the UAE or the goods are transiting UAE, the place of supply will be the UAE and there will be tax implications. However, if the goods do not touch UAE soil, for example, you are sitting in the UAE or a resident of the UAE, and you are buying goods from Libya and exporting them to Qatar, okay? In this situation, the goods are not touching UAE soil. So it is outside of scope and UAE VAT will not be charged. The default rule for supply of services is that the place of supply will be the residence of the supplier. For example, I'm Alif Accounting and Tax Consultant, and I'm resident in the UAE. I'm providing services to the United Kingdom, accounting and bookkeeping services. The place of supply of these services will be the UAE because me being the supplier, my residence is the UAE itself. Time of supply. This is a very important concept. It's also called the tax point. This is the date that is considered for each transaction. It's important for two main reasons. Number one, from the tax point, you have 14 days to issue a tax invoice. Also, the tax point tells you which VAT return to include your transaction in. For example, you are making the VAT return for the quarter January, February, March, and the transaction falls on 15th of February. This tax point is within the range of January, February, March, so it must be included in that tax return. The concept of time of supply is pretty complicated, and I will get to that in other webinars. But the basic rule is that the time of supply is the earliest of the below events. when the invoice is issued, when the payment is received, and when the service has been completed. The earliest of these three is the tax point. Here is an example of different events, and I want you to tell me what is the tax point. What is the tax point? Negotiation of the contract took place on 25th February. The contract was signed on 3rd of March. The service was completed on 20th of April, and the tax invoice was issued on 2nd of May, and the payment was received on 20th of July. So I'm opening up the floor to you guys. Please tell me, please open your mic and tell me what you think. Babarsha? Yeah. Yes, please go ahead. Anyone have any answers? बाबर साहब मैं क्वेश्चन पूछ रहा हूँ लेकिन कोई बोल नहीं रहा. Okay, since no one is answering, I will continue. They can answer in chat also. You can answer in the chat box. Hello? Anyway, no problem. I'll give you the answer. Negotiation of the contract is irrelevant because I told you that the three things to consider is when the invoice is issued, when the payment is received, or when the service is completed. The earliest of these three is the tax point. The contract was signed on 3rd March. This is also irrelevant. The service was completed on 20th April. This is relevant. The tax invoice was issued on 2nd May, and the payment was received on 20th of July. The earliest of these three events is the 20th of April, and the tax point is the 20th of April. So a tax invoice will be issued within 14 days, and this will be included in the tax return that covers April. VAT documentation. You must keep your VAT documents and your accounting records very safely and securely because the FTA can audit you at any time, and they will check if you are keeping your records. There are two types of documents issued in UAE VAT. These are tax invoices and tax credit notes. For real estate services, you must maintain your documentation for a minimum of 15 years. For other services besides real estate, you must maintain your documentation for a minimum of 5 years. Mandatory VAT registration and the historical revenue test. When your taxable supplies, which are 0% and 5% standard rated, plus your imports are greater than 375,000 dirhams in the previous 12 months, you must necessarily register for corporate tax. Sorry, for value-added tax. This is enforced by law. If you do not register, you will be penalized. And I think the penalty is 10,000 dirhams. You have 30 days to register from the time the mandatory VAT registration threshold is crossed, meaning that when you cross the 375,000 mandatory threshold, you have 30 days from that date to register. The effective date of VAT registration is the first day of the month following when the threshold is crossed. This is called the historical revenue test when you look back 12 months and see if your revenue has crossed 375,000. This is called the historical revenue test, and should be conducted by a business on a monthly basis. The other test is called the future revenue test. What this means is that within the next 30 days, if you expect your taxable supplies plus imports to exceed 375,000 dirhams, then you must register for VAT. The future revenue test should be conducted on a daily basis and to check if you anticipate your taxable supplies plus imports exceeding 375,000 dirhams. And also, this documentation, the invoices and the contract, this is substantiated by invoices and contracts. This is how you show that you have met the future revenue test. Here is another example. Genuine Clinic has just opened. In the first 3 months of trading, the business made the following supplies: standard rated supplies and zero rated supplies. You can see there in the table. What is the value of the cumulative turnover at the end of the 3rd month of trade, which needs to be compared to the registration limit? Please have a go at this and give me your answers. Yes, it is. Sorry, I'm new to Zoom, so I'm not sure. I can't see the questions. Sorry, guys, just bear with us for a minute. Yeah. Okay, these two questions I will answer at the end of the lecture. The questions are: can someone register for VAT if they wish to, even if they have not reached the voluntary threshold as yet? The answer to that is no. You have to reach the voluntary threshold in order to register for VAT. Okay, so I'll answer these questions at the end. Okay, how do we? It's not shared. Working. Can you help me? How do I go return to meeting? You just need to open that. Okay, great. Coming back to this, so you have your standard rated supplies and your zero rated supplies. As I told you before, both standard rated supplies and zero rated supplies are considered taxable supplies, and both of these have to be taken into account when seeing if you have crossed the mandatory threshold. So if you add these up, 5,000 plus 6,000 plus 6,000 plus 7,000 plus 9,000 plus 8,000, you will get a total of 41,000, and this is what needs to be compared to the mandatory threshold. So 41,000 means that you have not crossed 375,000, and hence you do not need to register for VAT. Here is another example. Using the historical revenue test, Oregano Restaurant commenced trading on 2nd January 2018. The taxable sales for the first 15 months of the business were as follows. By which date is the business required to register for VAT? So just a hint here, once you cross the 375,000 threshold, you have 30 days to register for VAT. So what you need to do here is you need to add these monthly figures and see when you cross 375,000 dirhams. So why don't you guys have a go at that? Yeah, have a go. Does anyone have any answers? Okay, here is the answer to this. Using the historical revenue test, um, you have the month, the taxable supply, and the cumulative turnover in the previous 12 months. So every month I add these up, and when I get to 30th of September 2018, the cumulative turnover has crossed 375,000 dirhams. This means that I have 30 days from this date to register for VAT. So here the answer is A, 30th October 2018. Now, the voluntary registration threshold. This, when your taxable supplies plus your imports are greater than 187,500, or your taxable expenses, local and standard rated, are greater than 187,500, then you may voluntarily register for VAT. There is no law enforcing this. There is no penalty involved. And both the historic test and future test apply to the voluntary threshold. And applying for the voluntary registration threshold is entirely optional. So the thing to note about the voluntary threshold is that in the mandatory threshold, we did not consider taxable expenses. But in the voluntary threshold, you can consider taxable expenses. If your expenses cross 187,500, you may register for VAT. The benefit of this is, for example, you start a new business and you have incurred many costs in setting up your business, and you have not exceeded the mandatory threshold. You can still claim the input tax, which would be very beneficial. So these are the reasons to register for corporate tax voluntarily, so that the company can recover input tax on their expenses, to make the company appear to have a substantial sales volume, and to show that a company is tax compliant and does not partake in tax evasion. Okay. Sorry, guys, I'm new to Zoom, so
Stop
yeah.
sharing. Then start sharing. No, share again. Entire.
Okay.
Can you change that?
Sorry.
The PowerPoint? No, share again. Stop share. Share the screen. Entire. Select the entire screen. No. Okay.
Okay. So that brings me to the end of my webinar. Are there any questions? Okay. So the first question was, as I told you before, can someone register for VAT if they have not crossed the voluntary threshold? The answer is no. You have to cross 187,500. Either your taxable supplies plus your imports are greater than 187,500, or your taxable expenses are greater than 187,500. Then only can you register for VAT. The second question is, I needed an explanation on RCM and the VAT refund process. Okay, RCM is a reverse charge mechanism, and this applies to imports. And what it is that it is considered as if you are making a sale to yourself, because the buyer of the goods, when they import goods from abroad, they have to account for the output tax, the buyer. Usually the seller is involved in accounting for output tax and input tax. But in this case, in RCM, for imported goods, the seller has to account for both output tax and input tax, and their net position will be zero. The VAT refund process, at the end of each quarter, you have to compare your output tax with your input tax at the end of the quarter, and then you have to check whether you are in a refundable position or a payable position. And there is a special application for VAT refunds, which you have to upload on the FTA website.